more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I'm Alex Steele in for John Farrell. This is the countdown to the open. We're moments away from the start of trading right here on Wall Street. Futures looking to a positive open. It feels like a turnaround Tuesday, buy the dip kind of Monday, but you have to wonder how much follow-through action there actually is going to be. Most stocks pre-market are in positive territory. You heard the opening bell right now. Let's get a check on other asset classes here because it's definitely a risk-on kind of day. You have the dollar a little bit weaker. You have bonds selling off, yields moving higher, particularly on the back end, the 10 and the 30 really re-rating there, up by about 4 basis points in the 10-year. And like I mentioned, it was buy the dip Monday, and that's what you're seeing in the crude market, up by 3%. But we have not reversed the losses that we got on Monday and over the last couple days. We're still down from where we were on Friday. So just keep that in mind as we head throughout the session. And there are plenty of question marks remaining as investors prepare for an uncertain year ahead. Morgan Stanley's Andrew Sliman using history to help forecast the futures market.
The first year off the low, like we had in last 2020, you have a very strong market because the Fed's just pouring money in. And the second year, which is this year, the market continues. It is typically in the third year that we're going into where returns remain positive, but they're not as strong because you have kind of a battle between still good corporate fundamentals, and I think that's going to be the story next year, but you don't get the PE expansion, you don't get the liquidity pump from the Fed.
All right, Elise Eisenbach, Eric Knudsen, and Henry Peabody still with us. Okay, that begs the question here, where do we think we're going to end 2022? What's the kind of return? Let's give me your base case here. Eric, you pick it up first.
Sure. So we think equity markets you're going to benefit from 7 to 10%, maybe 12% earnings per share growth in the U.S., maybe a little multiple contraction as real rates rise. And so you're in the mid to high single digits for the year for the S&P. A little better opportunities in smaller companies overseas, reflationary beneficiaries. That's going to outperform bonds. We think in credit, as our fixed income colleagues assert, this is going to be a carry year. You're going to get your coupon, not a lot above and beyond other than some volatility and some opportunity to trade tactically, and credit will outperform governments over this time period.
All right, Elise, what about you?
Sure. So for S&P 500, we see low double-digit return potential from here, somewhere in the realm of 10 to 12% from current levels, and a little bit more once you add in that dividend kicker. But importantly, we are expecting more dispersion in the market, again, in light of policy normalization and just ongoing risks throughout. Similarly, outside of the United States, we do maintain a preference for developed markets over EM and see really compelling opportunities in Europe with all of its embedded cyclicality, and also in Japan, given the recent news of fiscal support that's coming down the pipe.
Interesting, both of you looking at Europe and Japan for that. Hey, Henry, just a quick note on the credit market. What kind of return do you think we're going to see in the credit market, say, versus the bond market?
I'm glad you didn't ask me about equities, so thank you very much. The way that I think about it, as opposed to forecasting return, is try to think about what risks you want to take and how does that play into portfolio positioning. And with a rise in real yields, we want to stay away from duration risks. That pushes us out of U.S. credit and U.S. yields, favoring European credit. And in global portfolios that I manage with Pilar Gomez Bravo and Andy Lee, who are brilliant investors, that's what we've been doing, is overweight Euro, which has a lower duration and beta to credit risk. And it also pushes you out of benchmark into, for example, commercial real estate CLOs, CMBS. It favors probably a high yield allocation with less of that rate risk as we're early on in the hiking cycle. And it also ties in with probably continued dollar strength, which would be a headwind for local EM. So I think you need to be a little careful around rate risk and try to keep yield in the portfolio with some off-benchmark areas, but also maintain a substantial bit of liquidity as dry powder. Layer in hedges when you can. So it's going to be, I think it's going to be a pretty choppy year.
Bumpy year. Okay, one of the top performing stocks within the S&P this morning, though, is Nike, up by almost 8%. They topped estimates despite some supply chain issues. The team over at Jefferies wrote that supply disruptions will continue to dampen margins and sales relative to true demand and pricing power. We moderate our EPS and price targets slightly to account for Omicron impacts, but continue seeing a favorable risk-reward at current levels. Bloomberg's Kelly Lyons joins us now with more. Kelly?
Well, Alex, clearly investors are viewing Nike favorably this morning as it's getting a big lift at the open, as you indicated, up more than 7 percentage points, as is actually Micron, which also reported after the bell yesterday. I'll get into that in just a second. But first, to really dig into Nike, obviously it has been dogged by supply chain issues, given how reliant it is on production in Asia, where factory closures in places like Vietnam created major challenges earlier this year. It is navigating those challenges, though, a little bit more effectively, at least in the Western world, where the U.S. was really the growth driver of the quarter. North America's revenue up about 12%, helping offset a 20% drop in China and other drops in Asia Pacific and Latin America related to some of those COVID disruptions. And I would note that Nike also posted margin expansion of 2.8 percentage points, profit boosted by the fact that the company doesn't have to mark down its products as much because there's not a lot of inventory and demand is really strong. And then moving over on to Micron, it gave a better than expected outlook thanks also to strong demand for its memory chips. That demand emanating from networking, data center, and automotive customers, which actually make up the bulk of DRAM memory end use when it comes to revenue. And there's a supply side story here too, Alex, because computer makers, which of course are Micron's customers, were faced with a shortage of parts earlier this year, and that meant they couldn't make enough computers to meet demand. Now they are starting to see more availability of some of those other components. They can build more computers, and that translates into more orders for Micron, Alex.
It's such a good point, Kaylee. Thanks very much. It really points to the fact that demand is outweighing other concerns at the moment. Elise, Eric, and Henry are still with us. Elise, do you feel that demand is going to continue to stay this strong, that can kind of moderate any risks from the supply chain issues as well as inflation?
We do. Demand is absolutely the pillar that our optimism for 2022 stands on. And I think when you add in this dynamic of ongoing wage growth, which obviously is contributing to the inflationary pressures, we remain quite optimistic about the durability of demand in the year ahead, especially given all of the pent-up savings accumulated throughout the pandemic.
So, Eric, on that point, does that mean that retail, tech, they're going to remain kind of good bets here if demand's going to be that strong?
Yeah, we're playing kind of this in a barbell fashion. On one side, we are overweight semiconductors and big cap defensive stocks, both to take advantage of some of these supply chain issues and thinking of semiconductors as kind of the new copper of this recovery, but also wanting some defensive exposure in a way to help hedge against other exposures in the portfolio. The other barbell, though, is we're overweight a basket of reopening stocks that we think have been beaten down. They've rallied at various times over the last year and struggled more recently. And we think there can be an opportunity as we kind of get through this next wave to take advantage of kind of that next reopening wave, which could kind of has been pushed out into 22.
All right, so stay with me on this for a second. Henry, hang tight. I just want to ask about big tech. If you look at the NASDAQ 100, it has had some seriously whippy action. Eric, to you first. Where do these high beta growth large cap tech names still fit?
Yeah, it's really, we think of it as kind of a defensive holding, almost a proxy in some ways for long duration exposure, where long duration perhaps on the bond side has been less helpful. So we're really kind of barbelling a defensive position, kind of a concentrated position in some of those big tech names against some of the more, volatile, reopening, reflationary sensitive positions as a way to take advantage of both the opportunities, but also to get some hedging.
Elise, same question to you. Where's the growth tech names in your portfolio?
Yep, I like the way Eric is dressed, and I also like the way that he's thinking about it. It might sound like a millennial sort of mindset, but I think these mega cap tech companies in a way are kind of the new blue chips, right? profitable tech companies to us certainly belong in a portfolio as a means of, a long-term secular growth driver, but we too are balancing that with some of the more cyclical exposure. And I think in particular in the context of these supply chain conversations, like if you're looking for cyclicality, look at a sector like financials. It has the highest sensitivity to increases in interest rates, and it is more insulated to some of these goods shortages and supply chain issues that are continuing to persist.
Okay, so then on that point, as we see this nice move along the curve today, particularly a lot of selling happening over in Europe. Henry, weigh in on this. How much can the curve actually steepen next year?
I think that depends largely on communication out of the Fed. I suspect that what we're going to see into next year is a decline in inflation, a decline in growth, in positive growth, but decline in the positive growth rate. And we may see the curve begin to re-steepen a little bit as we start to question what the terminal Fed funds rate looks like. That's just a gut, but I do think that right now, frankly, curve flatteners are too expensive to be in from a portfolio standpoint. So we're relatively neutral to short duration. And I do think that we could see a little bit of a mid-cycle steepening here. And then if we start to see inflation remain sticky and the Fed re-up its efforts, then I do think then that flattening trade comes back in. So it's going to be a fairly challenging market.
I know we're just about 10 minutes into the U.S. Open, but I kind of wanted to end on Europe here because all of you kind of brought it up. Elise, you like Europe, and I'm just wondering how much of that is going to be a value play and a central bank divergence play. How do you think about it?
I think we think about it less as a central bank divergence play and more just as this confluence of the fiscal stimulus factors coming from the EU recovery deal. Again, that embedded cyclicality as hopefully some of these pandemic headwinds start to fade. And, also generally just compelling valuations relative to what we're seeing in the United States.
Eric, what about you? Where are the risks to your pro-Europe call?
Well, the risk is that the dollar stays strong and continues to strengthen, and that the U.S. once again defies consensus expectations and grows more rapidly than Europe. It happened last year.
Mm-hmm.
Once again, we're setting up with consensus expecting higher GDP growth in Europe than the U.S. And a weaker dollar. But we think that that's more likely to happen as we move into this stage of the cycle. We've seen potentially Fed kind of peak hawkishness and potentially peak dovishness in European monetary policy, and that can lead to a more conducive environment for a weaker dollar and more deflationary growth in Europe.
Oh, that's interesting because I feel like for a long time I was talking about the central bank divergence story, but it feels like maybe you're looking at more of a convergence. Henry, before I let you go, where do you see the ECB versus the Fed debate and then how that feeds into assets?
I see the Fed certainly leading. I think that the U.S. right now has the room, the growth headroom to absorb a stronger currency. I think the ECB is loath to take a stronger euro, certainly vis-a-vis the Fed. So I think that the Fed as sort of central bank of last resort is going to absorb currency strength because we have the headroom to do it. A few years ago, it was China. China had the headroom to absorb stronger currency, and now this is us. And I think we are going to take that role of handling a stronger currency, which means it implies that the Fed will probably lead the ECB by several months, if not quarters.
Guys, thanks a lot. Really appreciate it. Happy holidays to all of you. Eric, we all love the suit. I can't wait to see your New Year's suit and see what comes out with that. Elise Assenbach, Eric Knudsen, and Henry Peabody. Guys, thanks a lot. Happy holidays. All right, coming up, the volatile move in the Turkish lira. It's its biggest rally against the dollar since the 1980s after the government stepping in to shore up support for the currency. More on that next. This is Bloomberg.
is oxygen.
This is Bloomberg's The Open. I'm Abigail Doolittle. You're looking at a live shot of the principal room. Coming up, Stan Erck, Novavax CEO. This is Bloomberg.
I mean, it's an unconventional policy response, is putting it mildly, in terms of what they're trying to do. I think they've made it untradeable for speculators. They're not solving the economic problems. They're not solving the need, if they're going to have an economic recovery down the road, to get capital in. So this isn't a magic pill, but it deals with the short-term exodus of money out of the Turkish lira. This is A, unconventional, and B, not a magic pill.
Turkey's lira surging more than 20% against the dollar after President Erdogan unveiled emergency measures to curb months of depreciation. A rescue plan promising investors protection from the currency's wild swings despite concerning implications for the economy. Damian Sassauer, Bloomberg Intelligence, joins us now. Damian, first of all, what are the nuts and bolts of what President Erdogan actually did?
Well, there's really only one bolt. We discussed this at length yesterday. I mean, all the movement we're seeing in dollar lira is driven by locals, and locals, 60% of them, hold their deposits in a foreign currency, not in lira. And so what Erdogan's plan is effectively to do is to compensate those holders of non-lira deposits for any FX losses that may occur. So let's just be clear, there's $265 billion of hard currency deposits within the Turkish banking system, and now the Turkish government is going to backstop all of that for FX losses going forward. Think about this. That's 3 to 12-month deposits. I mean, the policy rate in Turkey is something on the order of 14%. So let's say it's a 15% deposit rate that a depositor would expect. If the lira declines by 20%, that means the government is going to have to come up with the 5% differential. So clearly the burden is now squarely on the government's shoulders to compensate for FX losses, and that is, from a creditor's perspective, not a very good thing.
Right. Do they even have enough money to do that? Let's say they had to do it for all the deposits. For the lira deposits.
It's a great question. And what money they don't have, they're going to have to print. So what does this mean? This means their fiscal deficit is going to surge. Right now, that was one of the bright spots of Turkey, the fact that they only have a 2.7% fiscal deficit relative to GDP. That's going to rise. And more importantly, the monetary base is going to have to expand. I mean, they're going to be printing lira in order to come up with the difference if the lira continues to depreciate, and that is hyperinflationary.
All of this sounds really positive. Damian, thanks a lot. Damian Sassauer joining us there. Over here in the U.S., the president's economic plan is in jeopardy as the White House is trying to revive talks with Senator Joe Manchin.
We're ready to move forward and get this done and work like hell to do that with Senator Manchin, with members of the Democratic caucus across the Democratic Party, and that's our focus moving forward.
Senator Manchin placing the blame on the White House staff and fellow Democrats in a Metro News interview saying, quote, they know the real reason what happened. It's not the president, it's the staff. And they drove some things and they put some things out that were absolutely inexcusable. For more, Bloomberg's Anne-Marie Horton is back with us. Anne-Marie, can Joe and Joe come to some kind of deal here?
Well, it does sound pretty personal and a lot of politics involved. But on the heels of a Sunday evening phone call between the two Joes, Senator Joe Manchin of West Virginia and the President Joe Biden, it does seem like that hard no is potentially, possibly a maybe, and that there is this open door to negotiate a policy framework. What Senator Manchin really is pushing for is revenue changes, especially when it comes to the tax code, as well as to make sure that pre-kindergarten for all U.S. Citizens and students is fully paid for 10 years. One item that is definitely going to be up for a big debate is the child tax credits. Those at this end of this year are now going to be expired. And this is something that is pivotal for the president and is going to be part of his legacy that he wanted in there. Many progressives want it. And Senator Manchin has a lot of reservations about it. And really the key, Alex, is that even if the president can get Senator Manchin on board, he still has 49 other senators to deal with. And their priorities potentially don't match up with those of Senator Manchin. It'll be interesting to see what happens tonight because the Democrats will be meeting around 8 p.m. and it'll be interesting to see if Joe Manchin shows up.
Well, I think you raised a really excellent point, and I wonder where the progressives of the Democratic Party are in terms of how they see this now. As a whole, will they be willing to take less but get something?
We'll have to remain to be seen what will happen now in the House especially, but really the power at this moment is going to be in the Senate. Can Senator Schumer corral all of them to get on board. And I think this evening will be incredibly telling. One, depending if Senator Manchin even shows up, if he's going to want to have that debate with the rest of the caucus, and what they map out as a path forward, because Senator Schumer says he's willing to put what the House passed on the floor in early January. But we're also hearing potentially the House is going to go back and start to potentially take some of Senator Manchin's reservations on board and map out what a new plan will be. For the progressives, I think they want to be able to get anything done and then take what they didn't get done on the campaign trail in November.
That's such a good point. All right, Emery, thanks a lot. Really appreciate Emery Hardern joining us there. All right, let's get a look at your sector breakdown here. We're about 20 minutes into the start of trading. You're still seeing a lot of green on your screen. Volume also not terrible. Credit Suisse Investment Committee, though, cutting stocks to neutral because of Omicron. Let's get to your price action with Bloomberg's Kriti Gupta.
Yeah, Alex, a true turnaround Tuesday, and here's how you can tell, not just because of the green on the screen, but the sectors that underperformed yesterday, well, they're outperforming today and vice versa. You see energy, financials, industrials right at the top of the leaderboard, and that is, of course, your classic reopening trade sectors, but that isn't necessarily the case when you're looking at a fundamental perspective. The idea that the Omicron variant still is actually spreading and raging, really affecting that growth outlook. To the downside, though, you have consumer staples and healthcare. Once again, these were the two sectors that were the outperformers yesterday, once again, on that classic variant growth trade. So classic turnaround Tuesday, even on a sector basis. I want to take a quick look at those small caps, though, because that is actually a sector that was booming in 2020 and for the better part of 2021, where you really saw that reopening trade, the idea that economic prosperity, this fiscal stimulus, it was going to boost even the smallest of companies. But really in 2021, that trade has stalled, is really traded in kind of a horizontal range. Now you're looking at it at the bottom of the trading range. The question is, does the Omicron variant actually start to push that even lower, breaking to the downside, Alex?
Yep. Thanks for the roundup. Really appreciate it. Kriti Gupta joining us there. Coming up, it is all the market moving events you need to be watching. That's coming up next in our trading diary. This is Bloomberg.
Is oxygen.
This is Bloomberg's The Open. I'm Alex Steele, in for Jonathan Farrow. Let's take a look at these markets here. Volume kind of could be better, could be worse kind of situation, but the Russell 2000 gaining back a lot of the losses from yesterday, up by 1.5%. But the S&P is up just 0.5%. We haven't recouped all those losses from yesterday, so pay attention to that. Some of the worst performers in the S&P, you're looking at Pfizer and Moderna, so those vaccine trades. On the flip side, Nike holding up really well, Micron holding up really well. Earnings still do matter, as both of them see a relatively better 2022. In the bond market, you have some buying of stocks, you got some selling of bonds. So that typical trade now kicking back in, particularly in the back end here. You're selling on the 30-year up by about 4 basis points, the same for the 10-year. The curve a little bit steeper. All right, time now for the trading diary, what you need to be watching for this week. President Biden will be speaking on COVID today at 2:30 p.m. Eastern Time. Plus, you get U.S. GDP figures and consumer confidence coming on Wednesday, and a host of economic data crossing on Thursday, including another round of initial jobless claims and UMich consumer sentiment survey. And finally, on Thursday and Friday, U.S. markets closing for the holiday. I think we're all really, really counting down to that moment. This is the countdown to the open on this Tuesday. We'll catch you tomorrow. This is Bloomberg.
It's because you're a Leo.
Melatonin.
Just go shopping.
We're excited to do business with you, but before we sign, I gotta ask.
Sure, anything.
We searched you online, and maybe you can explain this?
Can't believe that garbage is still coming in. That is so false.
Frustrated with your online search results? Call Reputation Defender today to join tens of thousands who've improved their online reputation. Get your free reputation report card at reputationdefender.com or call 1-877-866-8555.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Tuesday, December 21st. Here are the top market stories that we're following for you at this hour. Free tests, no lockdowns. President Biden addressing the nation today on his COVID response plan, promising 500 million free tests. We speak to Stan Erck, Novavax CEO, about where his vaccine fits into the picture. And it's Comeback Tuesday yet again. Equities, commodities stage a rally after getting beaten up on Monday. What would signal an unviable dip? And Turkey's de facto rate hike. President Erdogan promises to pay more lira to deposit holders, trying to put a floor under the currency's free fall. Is it going to work? From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, I feel like if we can't take yesterday's price action seriously, do we really have to take today's price action seriously? When do we get a clean read on the market?
I would say today's price action is less useful than yesterday's price action. The volume is down. I don't think you're getting a particularly high level of participation in the market today. Yes, we're up, but it doesn't feel that convincing. Yesterday I thought was pretty interesting in as much as what we saw there was actually the selling reaching into lots of different places in the market. And I thought that was fascinating because that wasn't just a kind of we're going to sell big tech. It was like we're going to sell pretty much everything.
Yeah.
And I think that may be an interesting little narrative that's worth paying attention to.
Yeah, the rotation in the market too, and it's hard to know if there's a story we can really take out of it. Like Pfizer down almost 6%. That's the biggest intraday drop we've seen since June of 2020. On the flip side, Nike and Micron, after having a better outlook for 2022, kind of outperforming. How do those two fit together? I don't know. Maybe we're in a stock picker's market. We have to wait for a narrative to really take hold.
Well, I think we just need some clear signals. I think we need to get through the holidays. I think we need to get people back. Maybe people don't come back. Maybe Omicron is a feature of the landscape early on in the new year. I think there's a lot of things that are hard to judge at the moment. And I think the market's slightly struggling with it. But I think the one clear takeaway, and Gina Martin Adams was really pointing this out a little bit earlier on, was take a look at the NASDAQ 100-day moving average. Market gets pinged down to that, bounces off, and that is just repeating time and time again. And Alex, that takes us on to our question of the day. When do we get to what signals an unbuyable dip? At the moment, the market is conditioned, absolutely conditioned, to continue to buy the dip. Well, let's kick this around with our guest, Catherine Rooney-Vera, Baltic Capital Markets Chief Investment Strategist, and Bloomberg's Vince Signorella. Vincent, to his friend and mother. Okay. Nice to see you, sir. Vince, what did you make of the price action? What do you make of the price action over the last couple of days? We're back. We're buying the dip. Today doesn't feel that convincing to me. But as I say, we're bouncing off that 100-day moving average. The trend largely feels intact.
It does in some way, and actually we're bouncing off the 100-day in the S&P, where we haven't really challenged it. It's been the same kind of pillow that sort of captured and held the market pretty much into 2021. You also made a good point about volume. A lot of traders at this time of the year are settling back, more trimming positions than really aggressively trading. You've seen a bit more day trading perhaps, but longer term positions are taken off a little bit at this time of the year. No one gets paid a bonus on what they make in December, and you can only get bonuses taken away. You can't get them added on. So a lot of folks are stepping back, watching this game, and I don't think you're going to get a real read on the trend for the market until we get our teeth into 2022.
And you make a good point, Vincent. You know, I'm looking at some of the market action here. Cassava Sciences was up 50%. That was on Reddit. And now it's just about up 31%. But that meme stock and the day traders like clearly in the market in some capacity. Catherine, it's great to see you. Same question for you. What signals an unbuyable dip?
Well, of course, a dip by definition is something that's going to bounce back. So if we know it's a dip ahead of time, everyone's going to be buying it. But a major correction, I think, would have to be precipitated, Alex, by the market realizing or knowing for sure that the Fed is not going to be there to support it. So a loss of credibility by the Federal Reserve, or a change in, not just a change in tune, Alex, but a complete 180-degree shift in how the Fed engages in monetary policy, I think would be what would startle the markets and cause a major downside reaction. That is, of course, that the Fed is, not just suddenly cuts tapering altogether and hike rates, or does something to that vein. I think it would cause the market to really lose faith in this structural upside move that we've seen for the past, decade.
Yeah, it's been about a decade. Catherine, have you been surprised how well investors, particularly equity investors, have taken in their stride what the Fed has done? We've had an accelerated taper. The market shrugged its shoulders. Yeah, we're still good to go. We've got 3 rate hikes priced in for next year. Yeah, you know what? We're good to go. What Fed policy would actually change the narrative that the market is comfortable with? What would it take to get us over that hump? Maybe the balance sheet roll-off, is that a factor we should think about? How should we think about the Fed and the way that the market is reacting to it?
The market just sees the Fed as infallible, right? It's just stunning that you can see this amount of curve flattening and this amount of little reaction by the Treasury market to a Fed that's really changed its tune, Guy, right? I mean, instead of 2, we have 3 hikes. We have a doubling of the taper. We have certainly more hawkish bent. The central bank saying that inflation is enemy number 1 to the economic recovery. So, and the market really is unscathed. That tells me that the market is already discounting both an economic deceleration, which is inevitable because this year we will have grown above 5.5% for the U.S. economy, but also that the Fed is able to tackle inflation so that, yes, there is inflation. We know it, we realize it, but the Fed has got it. So what could really deconstruct that, pillar of the market mentality would have to be that the Fed is hiking rates, but inflation still doesn't come down. And that we're not going to have until the second half of next year. So, Guy, my view and what I'm telling our clients is risk is still on. Stay long, overweight equities. Continue to buy any scare on a new variant. It's clearly a buying opportunity. We've seen it with Delta. We've lived it with Omicron. So continue risk on positions. But hedge those, buy those sectors, and we've said this at Baltic for the past year, inflation is the real risk. Buy inflation and rate-sensitive sectors and asset classes that can protect that other portion of your more risky portfolio.
Yep. In the meantime, buy the dip, ... until something changes in that respect. Hey, Vincent, where does that leave the dollar? I was really interested in the price action yesterday that I didn't feel like the dollar was responding in the same safe haven kind of bid that we normally see when we have a risk-off day in the equity market.
Well, I think it wasn't so much a risk-off day as it appeared. People seem to be wanting to say it was a reaction to the Build Back Better plan. I think it was more of a reaction to the variance spread. I think going forward into next year, we still see 2 sides. I think Catherine hit the nail on the head with the Fed. As long as the market feels that the Fed still has their back, not that they're going to raise rates, but that they have a handle on inflation, which still remains to be seen, and they could still lose that one. The dollar is going to appreciate. Basically, my view is dollar goes up either the variance spreads and people rush to it as a haven, or the Fed overreacts and raises more aggressively, and of course that gives people a reason to buy the dollar as well.
Vince, we've had a really strong run. What does history tell us about what next year could bring? What does history tell us about the chances of repeating another year like this year?
That is a really good question. History tells us there's always an opportunity for a pullback, and then you get that by the dip scenario. There's a very, very good chance we could see a 20% correction next year. There are 2 things going on in the market that I personally am not crazy about. We're starting to see a dip in personal spending and, more importantly, personal income. That is eroding real personal spending power for the consumer. If that continues with inflation going up and we don't see an increase in wages, it's okay to get inflation, but we need to see a commensurate increase in wages. If we do not, the buying power of the consumer is lower, the opportunity to spend is lower, earnings are lower, and therefore stock prices have to come down. And that is what we're starting to see right now. So unless we see a push from the consumer to have wage control, to get an increase in wages, we may very well see somewhere 3 to 6 months from now a major correction in equities.
Womp womp, 20% correction, 3 to 6 months. That is a serious projection. Catherine, you outlined what we need to see a serious correction. Let's play the what if game. What goes on sale if we see something that dramatic?
What goes on sale? Yeah, I mean, if we get a 20% correction, and it depends on, of course, what the motor of that correction is. But as Vincent said, I think it's a good point. Real wages are what you need to be looking at, especially if we're talking about inflation and how, persistent, or as the Fed, I think jokingly must have been joking when they said persistently temporary. But really the question, I think, is with the wage price spiral. So as he said, and that's right, if you get real wages that are continually and persistently increasing, as we have seen, real wages are up, and they're up big. If that's not counterweighted by by productivity gains, which Jay Powell has consistently said has been the case, but if that ends up fading, or we get a drop in productivity, then we get some serious inflation pressures from the wage perspective, the wage price spiral, which I think is, of course, very pernicious. So we have demand pull inflation, we have bottlenecks. If Omicron ends up exacerbating the issues that we've seen with the global supply chain, then inflation becomes even a bigger issue. So my biggest concern here remains the risk of policy error. Either the Fed has to jack up rates, either in a bigger magnitude and quicker, or they take a more dovish stance and let this unfold because they're concerned about unemployment, they're concerned about economic growth. The Fed is going to be hiking in an environment of decelerating economic growth. That's not a comfortable place to be hiking rates. So there's definitely risk, and I agree with your other guests with regard to risks going into the future. I do think, though, that the Fed is going to give inflation a pass for the next 6 months. So I'm more on the bullish camp for the next 6 months. I think risk stays on. I think the Fed is still backing the market. We've heard 2Q, 3Q, Jay Powell says he expects inflation to decelerate.
Yeah.
If we don't get that, then I do suspect we're going to be seeing more aggressive moves from the monetary policy front.
All right, and we're going to break down kind of what all this means for other asset classes elsewhere as well. Guys, thanks a lot. Vincent Signorella, always good to see you. Catherine Munivari of Tqqq Capital will be sticking with us. We're going to break down how to position for a Fed rate hike path, how to position for a policy mistake, what it means for the dollar, then what it means for emerging markets as well. This is Bloomberg.
I've been pretty optimistic from the lows, simply because the Fed was going to be ultra accommodative, and as the central banks begin to move off that accommodative pivot, it means that equity returns are still going to be positive, but they're going to be lower. And in that environment, I simply think that it requires a little bit more of a balance between risk on stocks and risk off stocks.
Andrew Sliman, Morgan Stanley, talking a little bit earlier on, talking about how the Fed is going to affect the equity market outlook from here. Catherine Rooney-Vera, Baltic Capital Markets Chief Investment Strategist, still with us. Catherine, Morgan Stanley are quite cautious in terms of their positioning on the street right now, but they make some interesting points about what is going to happen next. We've all got very conditioned to this idea that we're delivering and we're able to manage kind of outsized returns. It's been a fantastic year this year. Maybe we go into a more kind of low single digit, maybe even high single digit return story, but nevertheless, it is going to be single digit. In that kind of environment, do I want to position for the dips, to carry on the conversation last time? Do I need to keep capital back to take advantage of those opportunities, or do I just want to be fully invested throughout this entire process?
Yeah, Guy, I think it's a fantastic idea to have some dry powder on the sidelines for any potential dips. There's a lot of questions still in the air, not only from the COVID perspective, but also from the monetary and fiscal policy perspectives, as well as with economic growth. Is it going to be a steeper slowdown than a lot of people expect? And Morgan Stanley, I just heard from him, but we've also heard from Goldman Sachs, and they've reduced their economic outlooks for 2022 for the U.S. economy a couple times, if I'm not mistaken, in the past week already. So yeah, I think it's a fantastic idea, but I do agree we have to be defensive. So we're going to be buying sectors or even geographical regions that have dragged the U.S. performance a little bit. So healthcare in the U.S. we like. The valuations are still attractive. Banks we like because, you know, we do expect some sort of steepening of the curve in our base case scenario for next year. Rate hikes, banks of course are a beneficiary of that. Europe and Japan still have dragged the U.S. performance, so we see additional upside there. Within the emerging market space, there are some selective opportunities as well. So, you know, the markets always present opportunities. We still see some right now. While we are seeing additional upside in equities over the course of the next 6 to 10 months, we are actively advising clients to engage in those, you know, have some cash, have a position in cash, but certainly hold a position in gold, have a position in alternatives, names that have lower correlations with the equity markets.
Hey, Catherine, does all of that imply a weaker dollar relatively?
Yeah, look, the dollar has countervailing winds. So on one hand, we do expect the Fed to hike rates where their counterparts in Europe are not going to be doing so. But at the same time, we have fiscal deficits that are still, 10% of GDP, and we have a lot of downside to the dollar. I personally think, Alex, structurally, the dollar is weaker and going weaker. But over the course of the next year, as I said, there are some countervailing winds to that theory, and the first of which is the difference between what the Fed is doing and what other developed central banks are doing.
In terms of the emerging market call, where specifically are you looking? It's very easy to talk about kind of emerging markets as if they're all in one bucket, but they're not. Right. How do I separate and segment?
Yeah, sure. So Latin America does present some interesting opportunities. We had a shock election, if your audience has been aware of this, in Chile and in Peru. There have been some really surprises. So next year is going to be a tumultuous year there because we have some additional elections that could jolt the markets. But I do think there are some opportunities. For example, in Brazil or Mexico, both in fixed income and in the equity spaces, there's quasi-sovereigns that are energy-based names that we find attractive in the fixed income space because they have a nice, juicy yield. And also in the equity space, the Brazilian real remains very oversold. Then within China, we like Chinese consumer discretionary. This is a structural recommendation, and China has been beaten up, as we probably all are aware, over the past couple of months. So we do see some opportunities there. So yes, it's not all EM are not created equal, but we do see opportunities, especially in China, in Brazil, and in some cases in Mexico.
So, Catherine, let's stay on China for just a moment. What kind of policy support do you think we're going to get on the monetary and fiscal front from China that would support your view? Because in theory, they have to do that in order to help people buy stuff.
Well, I can tell you what doesn't support my view. My biggest fear here is that the Chinese authorities decide to devalue the yuan. I think that's a possibility, because if the Chinese, in theory, are accepting a slower economic growth, say 5.5%, are they really willing to cede almost wholly their market share as the yuan appreciates in terms of exports I'm talking about? So this is probably, for me, one of the biggest risks, is the potential for devalue of the yuan to support export markets. But that goes in against what the authorities have been trying to do, which is make China a superpower both economically and politically. And in that vein, they need to support the domestic demand component. So to be supportive of my view, I think that the authorities would have to continue their structural objective of getting China from an export powerhouse and roads to nowhere and ghost town infrastructure-based economy impulsed by government spending towards one based on private investment and private consumption. And I think that's the direction that this economy is going, and that's why we have been recommending at Tqqq this structural long position in this area.
Do I buy direct or do I buy the proxies? Do I buy Nike on the fact that it may start to... Nike. I'm sorry. Nike. Got us a victory.
We'll forgive you.
Nike's struggling in China right now. As that starts to turn around, do we start to see some of those consumer stocks that have been focused on China in the past starting to come back and come back strongly? Do I need to go direct to China, or can I buy US multinationals, European multinationals that take advantage of that?
I would buy actively managed funds that focused in China. There are some excellent ones out there, and we're not going to pretend to be experts in all of the subsectors and specific names within China. So what we're recommending to our institutional and retail clients is precisely that: actively managed funds by guys who are focused exclusively on China. That's where we think value is, and that's where we put more faith in the ability for active managers to do that. So that's probably one of our most important emerging market recommendations entering into next year. Of course, there are risks. There's the devaluation, there's additional variants, there's additional closures, there's the potential for really black swans to happen. But the way I see it right now, with the Fed hiking, with global economic recovery, and really vaccines at least improving the fatality rates of COVID victims, I think there are opportunities in those undervalued areas, such as China, such as some emerging market names, such as Europe and Japan, to outperform.
All right, Catherine, thanks so much. Really appreciate it. Catherine Rivera of Tqqq Capital joins us. Coming up, we'll talk about Nike. I was like, what company is Nike? Nike does it. Shares are up today in a sales beat. It also said consumers won't have to worry about those Air Jordans making it under the tree. More on that next. This is Bloomberg.
It's worth.
Shares of Nike are jumping after the companies. Yeah, I'm just here to help. The latest results. Bloomberg's pretty good to digging into the details.
Absolutely, Guy. Nike actually beating their earnings estimates. It's not the first time they've been beating them since that 2020 pandemic essentially halted the global COVID spending, and Nike was no exception. But take a look at this, a little bit of a divergence when it comes to who's driving those sales. Compare this North America sales to Greater China sales. One is negative by almost equal to the amount that North America is. So you can really see in Nike's earnings, the United States in particular was driving those sales higher, helping them offset the costs and offset the loss of sales that you're seeing on the other side of the world. A lot of that driven by, of course, those production delays in Vietnam, as well as just kind of reduced spending ability over in China. You see that in broader retail sales data as well when it comes to the kind of zero COVID testing policy that has really created some pretty tight restrictions over there. But take a look at this. Nike is no exception to the margin pressures that have been such a major part of the 2021 story. Take a look at this. This is, of course, the fiscal quarter. They go by a different calendar than we do, but you do start to see margins actually down from 15% to 12% in this latest quarter, and that's going to be a major issue going into 2022 as we talk about the supply chain issues.
Yep. Love Nike. Kriti, thanks very much. Kriti Gupta joining us there. If I have to say aluminum, he's going to say Nike. All right, coming up, New York City Mayor Bill de Blasio talking about $100 to get your booster. We'll talk more about the virus. This is Bloomberg.